Urs, good to be sitting here with you today. We're going to be covering the Mar-A-Lago Accord, or the infamous Mar-A-Lago Accord, that hasn't necessarily come to fruition, but there's a lot of talk about it, and to help people understand what it might do in terms of the currency of the US dollar and what the purposes are. I think to start out, it would be really good that we talk about the Plaza Accord first, which was in 1985 with the G5 nations. Those G5 nations were West Germany at the time, France, Japan, the UK, and the US. Could you give some background on the Plaza Accord, what it was for, what it was about?
Yeah, I mean, the Plaza Accord was about devaluing the US dollar. The issue was that the US dollar has become very strong, and that has hurt the US economy. And on the other hand, we had the German economy and French economy in particular that have been doing very well. Germany in particular, because after the war, they did rebuild their country, and that has helped them to thrive economically. And so at some point, the G5 countries came together and said, look, it's not sustainable. We need a weaker US dollar to support also the growth in the US and have a global sustainable economic growth.
Yeah, and I think it's interesting to see how the whole purpose, as you mentioned, was to weaken the US dollar,
right?
To boost economy, to try to push. I think an interesting point there, at the time of the Plaza Accord, I think the debt to GDP of the United States was at around 40-ish%, a little bit more.
That's correct.
And so a very different standpoint of where we are today. But I think even further on the Plaza Accord, what's fascinating is it's kind of regarded as a total failure because it worked too well in devaluing the US dollar, that they had the Louvre Accord.
Yeah.
And that was to re-strengthen the US dollar. And that was in 1987. So the Plaza Accord only lasted for 2 years.
Yeah, I'm not sure whether it was to re-strengthen the US dollar, but to limit the accelerating speed of how fast the US dollar has depreciated. Because within these 2 years, the US dollar has lost about 25%. So then obviously the leaders said, okay, that's also not sustainable, so we have to get together again, at that time at Louvre in Paris, and they decided, okay, we have to stop that and have to bring back some stability into the forex market.
Yeah, that stability is a better way to say it than strengthening.
Right.
But that's
because even after that, the US dollar weakened further for the next 2 years before it started to regain some strength.
Correct. Yeah, and even in the long-term picture, we've seen what the U.S. dollar has done. I mean, we look at those countries involved. West Germany is not a country anymore. The German mark is not there anymore. The France at that point was not on the euro. They were on the French franc. That also is not around anymore. So there's, the environments have changed. And that kind of brings us to today to talk about the Mar-A-Lago Accord, which is more in line. It's not one for one, but it's more in line with the Plaza Accord in terms of the desire is to boost the manufacturing sector in the U.S., to bring back American manufacturing. And part of the reason, or part of the way they can do that, is devaluing the U.S. dollar.
Right. And it's also about security. That's at least what they're claiming it is about, because at that point, the U.S. is bearing a lot of the costs for protecting the Western values and the Western world. And in their perspective, other Western economies that benefit out of that, they don't really contribute to the spending.
Yeah, in terms of the military defense spending.
Correct.
Yeah. And I think that's what I find interesting about the Plaza Accord, kind of Plaza to where we are in the Mar-A-Lago Accord today, is the fundamental differences in the U.S. economy that are sitting where they are. The makeup, how companies operate, and we have less manufacturing in the States. Still, there's a big manufacturing sector, no doubt. But to be able to agree to terms with workers to pay for that, that a company will buy our manufactured products from the U.S., there has to be some economic sentiment other than just the security that's being offered.
Right. And I think that's also the like the U.S. or let's state it the other way. So today the global, or like the world is much more globalized than it was back in the 1980s, and so the it's not that easy today to bring everything back to the US, because it will hurt the people, it will hurt or will have an effect on the pricing level, most likely on inflation. And so it's not something you can just do. And it's also not as easy because today, other than, 50 years ago almost, or 40 years ago, Germany is not doing as well. And so we have the euro, which is covering the European Union, and we're having the Chinese renminbi, which are the most used trading currencies with the US. And also China, we have talked about that in previous videos or episodes, is not doing very well. So it will be much harder today to bring them together and make them agree to a Mar-A-Lago Accord to weaken the US dollar, because they also want to have a weak currency. They also want to have like a position of power or strength to export their products and to bring up their GDP.
Yeah, absolutely. And I think that's where you see the difference, the fundamental difference between the kind of the competition of the manufacturing sectors of China, where the manufacturing sector, similar to the US, maybe 60 years ago, brought the wealth up through manufacturing of the people, but now we're at a stage where we have a very high level of wealth in the US, and China's in that growing stage. And so trying to kind of compete there is going to be challenging. And as you mentioned, to get that, there has to be some momentary pain if they want it to come out in the long term, the way they envision this boom of a manufacturing. There has to be some turmoil in the midst to get to that point again. And the other side is just the amount of debt that the U.S. has, and the fundamental different position that it's in around the world already. Its currency weaker than it was back in the 80s. Its debt levels way higher than it was back then. And it presents a very challenging situation.
That's correct. And on top of that, I think it's also important to see what is happening currently in the global landscape with all the tariffs. If you look at that, having in mind the Mar-A-Lago Accord and the wish of a weaker US dollar, it makes totally sense that there is some leverage that is built up over time. So to eventually get everyone on that one table and say, okay, look, we really want to have a weaker US dollar. So if you play along, we can remove some tariffs, we can do that for you, or we can include you into our umbrella, safety umbrella, stuff like that. And there are, next to the Mar-A-Lago Accord and the idea of the weakening US dollar, there are also other ideas. One hedge fund manager, I think it was Stefan Maron, he put out a very interesting paper last November mentioning or discussing these different routes to a weaker US dollar without going too much into politics. Just like that's an idea that could work, that's an idea that could work, and put it in relation to the history.
Yeah, very interesting. Urs, thank you for the conversation today. I look forward to doing the next one with you.
Perfect.